None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Friday morning, once again, like last week, lots of volatility. We kind of expected to see some interesting volatility this week, and we certainly got it.
We have.
Considered doing a show on Wednesday with the rally to reconfirm that it didn't look like it was very valid at all. Looking at things going on in the world, I'm shocked that, like everyone, that Donald Duck, Mr. Pimco himself, has moved to Janus. And you want to find a good stock to short Janus. We'll bring it up. It's up like 31%. So I go, found, L. Ryan leaves, and then, they underperform all their peers. And then they use 70% futures contracts to leverage the fund. Then the SEC wants to know, hey, I don't think these numbers are real. And then 3 days later, this guy bolts out to Denver, goes from Newport Beach to Denver, and he's a billionaire. I don't get it. Somebody help me. Guys, email me if you think you understand this whole thing. But and I guess maybe he'll work out in Newport Beach so he can still drive his Ferrari. The Ferraris don't do well in Denver. Part of the time of the year. I spent quite a few years there. I started this company in Denver. But yeah, just bizarre stuff around this company. I mean, bizarre. I don't even know what to say. So, not to mention, he founded the company, or co-founded it. So it's an interesting situation. I'm sure all of us went, what? Anyway, but it looks like you probably short Janus stock, because when they figure out who's there, and maybe some of the things that can end up coming out of this investigation by the SEC, who knows what ends up happening and what fingers get pointed. Since he's running the fund that they're investigating, I think it's all kind of interesting, and I'm questioning Janus's management decisions big time. Anyway, so I guess if you have the Bond King label, you can do anything you want. But anyway, I'm sorry about that. That just really triggered me this morning when I see crazy stuff like that. It just doesn't make any sense. So anyway, Mitch, we had the GDP come out at like 4.6.
Yeah, we had the third revision for second quarter GDP come out. Went from 4.2 to 4.6, so it met expectations. Also had consumer sentiment come out at 84.6, which also met expectations. So
yeah, that was pretty much in line. And actually, I think the GDP was pretty much what everybody expected. A slight higher revision. So there wasn't not a lot there. Certainly, all the news is what happened yesterday. And actually, if you look at this week, one of the commentaries, I start off 2 steps backwards, 1 forward. Well, then it ended up 1 giant leap backwards again. So. We went from printing a week ago today, 2019.26, the historical high, and I'm looking at the screen at 1970.52. So we're 50 handles off the highs right now. And I've been kind of holding myself back from putting from a headline starting on the commentary called No Reason to Own. And there's no reason to own the stock market right now. And it's becoming obvious when we see this big short covering rally the other day, and only to see not only a reversal but a giant reversal. So a couple things we'll talk about this. We get through some of the indexes today, but from my viewpoint, there is a lot going on, and I'm seeing it's going to be interesting. I'm actually anxious now for the run tonight to see if we just blow out everything else that we don't own. It's looking like an awful lot of things from things I glanced through this week have broken the classic that everybody looks at, the 200-day moving averages. There's just a ton of stuff that's rolling over here, and the market gets continually narrow as it comes together. So anyway, I guess I just noticed something looking at the screen. You can tell who lives in the sun and who lives in the Mitch has got that nice I'm sorry, Mitch. I'm looking at myself. I look like somebody painted me yellow. So anyway, so all right, guys. Anything else that we've got out there that you're aware of?
No, that's pretty much it. I mean, the other newsworthy item that came out yesterday was the durable goods orders. Was a big miss on that. It was expected to be down 17%, and it was actually minus 18%. Of course,
they had that bogus report from last month. It was up 20 something. Yeah. So and everybody knew the books are cooked. Listen, there's only a few of these things that are worth watching, and you wonder sometimes why the market doesn't react to it, because it really they're immaterial, a lot of these reports, and we want to hang our head on. Well, this happened, so that caused this to happen. I remember, what's his name, Paul Kangas from the used to do the nightly business report or whatever it was on the PBS channel, and back in the days when I was on the trading floor, and I would turn this thing on at night, and I'd see this guy, and he's got every 10 minutes of the day, he's got an excuse for why. Well, this came out and the market rallied, and this came out and the market went down, and I'm like, I was there, I didn't even know that. I mean, I'm a participant on the trading floor with professional traders, and I never heard any of this stuff. And it was like, I guess the view is, and the problem is that everyone wants to have an excuse for what happens in the markets, and a lot of times there is an excuse other than there are just more buyers and sellers, and more sellers and buyers, and people are changing their attitudes towards these stocks. And I believe there's just about everywhere you want to look, there's probably bubbles all over. I hate to sound like Dr. Doom from wherever he hangs out. I think he's got a German accent from the Doom Gloom and what's his name, Mark Faber. Yeah, but there really are. I mean, you're looking at a condo in New York going up for $130 million. Now it's listed, it hasn't sold, but you're looking at art, you're looking at cars. I don't care what the collectibles are. There's a segment of this crazy world we live in that are just excessive about everything, and what people are willing to pay for things right now appears to be. I mean, I'm feeling. I made this comment maybe last week that I'm feeling the .com craziness again. Some of these startups, and you see all these big IPOs and stuff that they're bringing out that are just kind of seem to be really inflated, and people are crazy to want to buy, the Alibabas at $99. Like, I gotta have it. There's 50 million of them because they couldn't, because they cooked the books, because they only let something like 12 institutions primarily in on that trade. So then the public had to go and pay up, and while the institution sold them the stock that they got it at $68. So I mean, it's just I don't know. It seems wrong. You'd think the public would be smarter. I'm sorry, guys. This whole thing with Bill Gross really triggered me into some craziness. But that's what's driving, I think, the market sentiment right now, is that people are finally looking at this market differently. So let's go ahead and unless Mitch, you got anything else? Go ahead over and
let's go to it.
All right, let's take a look here at some of the technicals on the market, and I think this has been an interesting trade. And typically, and I thought about this when I woke up this morning. I was thinking about the market analysis here, And typically when you get a market that closes on the low tick of the day, and it's like everybody's selling in close, typically you'll get what's called an inside day the next day. So you don't make a lower low, and you trade within the range of yesterday. Of course, that's easy since we're down 32 points on the day. So that's pretty easy to do. But the bottom line is, typically when you get these closes where they close at the high tick of the day, they don't follow through the next day. They do on occasion, but something like yesterday that really was not news driven, because you're trying to find out what happened, and there really wasn't a lot of reasons. And that's what I was saying earlier. There's not always a reason for what the market does, other than the fact that people, I believe, are finally getting aware of what's going on. And I'm glad I didn't get myself started. I'll mention it, but on the if you look at the deficit, we're about to turn 18 trillion. It's probably another. I'm trying to figure out. It's got to be 2 or 3 more weeks away. We're 740 something like that. And I keep saying we're going to wake up one day and we're going to realize that this ain't working, and that this massive debt buildup and this Keynesian experiment that all the central banks have brought onto us is going to have a big impact, and it's not necessarily going to be a good one. So from a capital markets viewpoint, though, I think we're finally seeing some of this sentiment start to flow in, and it won't go, we're into the phase where bad news is bad news and good news is probably okay. We're not into good news where everything's bad. So when the markets get really negative and going outside of the banking crisis, but I remember back in 2001 and 2, the markets were just getting hammered, and there'd be decent news come out, or a stock would miss by a penny and they dropped the stock 10%. And so when there's a time when the markets get into this, the market sentiment gets so bad that they don't care what comes out. It's just another reason to sell. They're hoping for a bounce so they can get out of stock. And I suspect there's other elements that have happened here, and those are from a lot of buybacks that have happened. There's fewer shares out there to chase. There's still an awful lot of money hanging around, but it's getting, I guess, less willing to go in and buy some of these markets. And one of the things we just looking at here, I'm going to go off screen so we can see all the numbers easy enough here. And one of the things that you can look at here is the PPMs have not gotten that negative. They've actually ticked up today, just with this little bias to the upside we got. We're trading 1970.69 right now. We're seeing PPM 1 at 0.07, PPM 2 0.07, and PPM 3 0.05. So these are basically flat. We traded and closed under the 40 period moving average, and this is on a daily basis. If you look at this chart, you'll see the last time we did that was way back when we declined. It actually closed substantially below it. So we hovered along it over here where my cursor is and the crosshairs are, and then we went below it, and then we formed, and now this is the first time we've been below the 40 again for a while. And we'll take a look here in a minute when we go to weekly. We'll look at the weekly numbers as well. The 10-week moving average is a little bit lower than that, but not a lot. And so we're seeing this pattern, and let me just draw this pattern in because I think it's worth spending a few minutes on this just to talk about what's actually going on within these patterns right now. And so we're getting these little zigzag patterns here, and we have no Fibonacci projection downside. Don't know if I mentioned this. Certainly I'm looking at my notes here. I was supposed to in commentary last night, but the 20 I had mentioned there was new targets that were generated off of the rally 5 days ago now, and they were 2084 to let's see here, 2084, and as high as there were some numbers in the 2100 level, and those numbers were negated by the penetration of 1978.50, which we did yesterday. And today, as long as we stay under that number and we close under that 40 period moving average on a weekly basis, with today, then we're going to see further follow through. It doesn't mean the market will go straight down from there, but it does suggest that there is a breach that has not occurred. And let's go ahead and take a quick look here at the weekly graph while I'm there. And the weekly graph you're seeing is, let me bring up this dialogue here so we can see it a little better. So the weekly graph, we're seeing the fast average is 1075.60, which is the 10-week moving average. So those are always pretty similar from the 40-day to the 10-week moving average are similar in price. So we're 75.69. We stay below that. That'll be, first time that we've spiked below that since we went down to the 1905 level. And I believe that with what we're seeing here is really, really huge from the standpoint of from the PPM standpoint. So let me get out of the way here so I can show you these numbers here. PPM 1 is now negative on a weekly basis and at 0.04, 21.78. So PPM 2 is now below trend, as is PPM 3. And this, if you recall, just going back to Monday's show, the PPM 2 and 3 were still hanging right at trend mode. They have rolled over, so they're not going to react to this day-to-day noise like the daily charts did. And these are pretty significant moves. What it tells us is that we're probably going to head toward that 21 period moving average, which is 1956, and the long-term average, which is the 40 week, which in the same respect is very close to the value of the 200-day moving average, is 1901.71. And a close below that would have two effects. It would take out the 1904 number that we printed several weeks ago as a low before we did this rally. I think we lost 4%, rallied 6%. Now we're working on taking that back. But the pattern suggests if we get there that we should test down to those lows. So a close under the 10 is going to tell us, with what's going on with momentum, that we're heading toward that 40 period moving average. And let me take this off the screen, and so you can see this whole average, this long green line. This goes way back to February of 13. Let me zoom in just a touch more. Yeah, so we went below it back in October of 2012. This entire rally that we've had for the duration of this entire rally has been above this 40 period moving average. It's only been somewhat tested once over here where it went down, but to the 21, and then it spiked below it, but it didn't close below the 21. So there's going to be events most likely going to happen in the next 2 to 3 weeks that are going to tell us that number is going to get retested, that 1905 number. Penetration of that number sets up a whole nother scenario, and we'll see. We'll take a look at the monthly, and we'll see how in depth this should be discussed, because what I'm seeing here is at least a test of the 40. We can get ahead of ourselves, but if those numbers are taken out, we are now talking about seeing numbers between 1750 and 1640. We're talking big decline, and that's getting into somewhere between 7 and 12% range. And I believe that's just the beginning, because I've talked about this way back when, I think in our annual reports, as well as just dialogue that we've had over the last several months. I think this is probably close to our 71st or 72nd show that we've done now, and we've been discussing these longer term patterns, and that there's a very strong chance that there's not only a high here, but a significant high that could be a high for many, many years, because I'm a little tied up, and I have been for years, and part of our job is to follow the trends, and the trend, we've been following that trend. So we've been mostly long this thing, with a little disruption since fall of 2012. When this market finally got some serious traction, we were on this trend, and it's went up. So part of doing what we do is following the trends and also recognizing that there's a switch in the trends. And everything you see on this screen, you look at the PPMs right now, this is there's divergences. Let me show you a couple things here, and this is, these are things that it's difficult to write in commentary because it would take me forever, and then by the time Mitch edited it, would get out about 4 hours after the open. So it's just way too much to cover. So, but I want to show you these peaks here, where the market is. I'm just going to draw some arrows down here. But if you look at these peak values in these indicators, and look where the market is. So what happens is, now we made a new high just last Friday, remember, and meanwhile all of these indicators are not printing above their previous highs. So this is, from a technical standpoint, referred to as a divergence, and where you have prices making new highs but momentum isn't confirming, and it's almost every top will end on the basis of that this event occurs. So you get new highs, and then you don't see the momentum surge. And if you use things like stochastics and other types of MACD and some of those things, you get into more of any of these indicators that are 0 to 100 meters. They just get up to a point, and they always diverge when the markets are strong. So it's impossible to read them. The indicators, PPMs, are a pure measurement of momentum, and they have no limits on how high they can go or how low they can go, depending on what's happening. And as I've talked about over the show and educating you folks on the thought process between, is that these momentum of 1/4% per week is a trend, and when these moving averages are advancing up. And what we're seeing here is the opposite, where when we get to minus quarters, then we have serious downtrends unfolding. But this, you can see all the way back here. Let's see, I'm going to have to get out of the way here just to show you this one. But what you see all the way back on this bottom indicator, the PPM3, it's basically been flat. There's a couple peaks, but this entire rally, all it's been is between the 20 to 40 range, roughly, is the spectrum. So 0.20 to 0.40, and it's maintained that through this entire uptrend. So we are at the bottom end of that now, and that 40 needs to be tested, only somewhat tested back in earlier this year when we had that early February decline. But it's bounced off of there. This time, I believe this test will fail because of where the pattern is, and that the momentum has dissipated to the point where it has. So we're sitting there right where these things are going to break down. It's going to be interesting when we get the first print on Monday to see what happens with these indicators. And let's go on and look at the monthly graph, and I think that's gonna show us exactly one of the things that I was talking about. If you recall, just by printing up to the 2019 level and being above 1994, we were at the PPM1 was greater than the 1% level. And just bringing up this chart here, you can see that down at the very bottom here, PPM1 now is 0.88, and as long as we stay below 1990, I believe it's 1994 was the trigger point. As long as we stay below that number this month, for the month of September, which doesn't have much to go, by the way. That's the other thing reason why I want to bring up this chart. There's a lot to get through here as I dig into this. But 0.88, what we're finally seeing is the decel in the 10-month moving average. And that 10-month moving average right now, we're looking at 1903.61. So think about what is going on at 1905. That was the low of last month. It's the 40-week moving average. It's the 10 week or 10. What am I trying to say here? It's the on this chart, it's the 10-month moving average is at 1903. The 40-week moving average on the weekly graph, and then there's the low of last month, which is the pivot point. So we have a cluster of things. And I always look for these clusters when you're trying to put an analysis together. And the more things that you get the same answer, it tends to validate that area. If you recall, just a couple of days ago, the 1978 level, right where we printed down to 1978.68 actually, and the market reversed, and we closed at 1998 that day. So we reversed 20 handles that day, only to come in the next day and drop 32. But the point is that those numbers are really significant. So anywhere we get down as this market evolves, as I expect, as we get down to those levels, we'll be able to fine-tune some of the trigger points, because we'll have more intricate patterns that will be relevant to, rather than predicting, that will actually be more relevant from the predictability will go up in the probability. So the bottom line is that this is going to be a key number. We get under the 10-month moving average, that's going to set up a move to the 21 moving average, which is still up 1.5%. So it's in trend mode longer term. So what likely is happening is, if we can get through, this will be next month, by the way, October, which is not a big month, a good month normally. Yes, everybody's expecting the market to bottom in October, so that might tell you, beware of that. Matter of fact, everybody, remember this sell in May and go away guys? They're not doing real well. They're still not feeling very, very good. And the bottom line is that some of these seasonalities that are coming into play here probably are not going to play out exactly like you expect. So looking at the PPMs here, you got 0.88 over here, 0.50 and 1.0, and these are on a percent on a bar by bar basis. So we are going to see when does the month end? It ends next Wednesday. So on Tuesday will be the last trading day of the month, and that when we get the new bar, it's going to be real interesting. My expectation is that this number is going to drop even down further, and we're going to see a further decel in the angle of attack. So those of you who've been watching the show for a while, you understand that the angle in which the moving average is tells you a lot about the probabilities of whether that is going to be a valid trend line. So the problem from technicians that draw trend lines is they're somewhat subjective, even though there's some criteria that you draw those trend lines with. In my opinion, it's much better to use a moving average that's adjusting to itself, and then determine, this is what my entire life's work has been about, is figuring out when that trend line is valid and when it's going to be penetrated, or on either side, whether it's going to go above it or below it, and when that signals a trend change, and how to evaluate these things through the internals. And I use the rate of change and the first and second derivatives of those rate of changes to determine that those where they are in that angle of attack. And this 0.88 is the beginning signs. I've talked about this before, of when a major top is playing. It happened in 98, it happened in 2000, it happened in 07, and it's happening again, just like it always does. The difference is that the underlying trends, it's going to be interesting to see how long that it takes to form this top. I still think it's probably 3 months, maybe as much as 4, before ultimately what we end up doing is we end up testing the 40 period moving average in this pattern. And that 40 period moving average, just for the record right now, is 1559. I don't know, Mitch, you got your calculator out. If you can figure out what a percent drop from current value down to 1559 is, that'd be handy to have. But I'm guessing about 22-24%, my guess. But so we're looking at a pretty significant. And by the way, remember, this is a monthly graph, so it takes months for these things to happen. You could have a big drop once you get through this 21. We get through 1905. It could decline sharply down to 1962, but my expectation is that we go just below that, then we rally up and we set up a right shoulder So November probably is an up month, and December is maybe an up month as well. We'll see.
Santa Claus rally, right?
Yeah, possibly.
Yeah,
But
yeah, that would be a 21%
that's
drop, by the way.
pretty good guess, huh? Not bad. So we used to have to do things in our head in the trading pit. We actually at one stage, I don't even think we had calculators. If we did, they were so big you couldn't sneak them in the pit and hold them all day. But the bottom line is that these are what's happening here is part of the end of a trend, by the way, not the beginning of the next trend. This is how they end. This is on a long-term graph, and and I haven't been Harry Dent. I haven't been John Hussman, and I've been short since 2009, telling everybody how bad things are. The bottom line is things have finally gotten to the point where these turnarounds are happening, and it goes to everything that I've done and all of the work that I've done for 30 some odd years, 35 years, and I realized I built the first VPM prototype in 1994, which was 20 years ago. That synapse happened the other day, and so been doing this a long time. It doesn't make me right all the time. What it does is give me a lot of experience, and what I'm trying to do is give you folks as much as that experience and knowledge that I have, so that when you're looking at this stuff and you understand what we're doing, and that's the point of the Market Thunder show, is just to get that perspective. But these monthly graphs are telling a story, and this story is a long-term story. And when they start to roll, they're 18, 24-month trends when they switch. This is a very, very long trend that we've been in. If you go all the way back to '09, we're looking at one of the longest trends that have been in place. And like I said, a week ago today, we were printing historical highs. So we certainly haven't collapsed off the highs to that extreme, but they're certainly getting harder and harder. We've been above 2,000 so many times it's nauseated me. I just get sick of seeing the thing that's 2,000 again. Nobody's going to own it up here, and sure enough, they knock it back down. And every time that happens, that it's harder to find. We used to talk about in the trading pit finding a bagman. It's hard to find a bagman. You beat up enough of these guys buying this thing over 2,000, or paying Alibaba $99. You can only find so many suckers for so long, and they even the suckers get smart. And so the bottom line is that that's the market sentiment, is people are willing to take actions, but when they get punished for those actions from a trader environment. And let's face it, we trade billions of shares every day. If you think this market's a buy and hold, you're completely wrong. This money's moving around all the time, chasing. Sometimes a dog chasing its own tail, but it's always moving. This stuff is moving all the time. So that's the reason why everybody's on there. And I have actually been excited about the dialogue that's happening on CNBC, because they get all the mutual fund salesmen and all the guys that are out there, and a typical off-the-street money manager that has billions of dollars and makes him credible. And he says the same thing the other guy says, which is, nothing's going to change the market. It's just going to keep going up. And, the Morgan Stanley's talking about 2,100 and 3,000 and all these crazy numbers. This is what it sounds like at the top, best I can tell.
Yeah, every day is a good day to buy.
Yeah,
so
that's it. But the bottom line is what I'm not doing is not predicting. I'm observing what's going on, and that's, in fact, that's the entire process that I built. It's the process of responding to changes in the markets that make logical sense and that have probabilities behind them, and that is how you become a good market technician, trend follower. You don't predict anything. You respond to these changes, and your job is sort of like a quarterback reading the defense. He knows where to throw the ball. The good quarterbacks know where to throw the ball, and that's why they can throw the ball in spaces it doesn't look like there's an opening, but they see that window faster, and that's called experience. And you just get that by years and years, and I have plenty of gray hairs to prove it up here. So, but like I said, it's about understanding what the situation is, and it doesn't make it improbable that this thing reverses and goes up to 3,000 or 2,100, whatever number you want to pick. It just says right now that everything is stacking against us, and you're still not seeing a lot of this. And like I said, I'm still worried that we go through these even numbers on the debt calendar. I don't know if you guys have ever looked at that, but I'm sure most of us have at least brought it up for a few seconds. And you watch, it's about $1 million every minute's being spent, and it's scary to watch. You watch it for about 10 minutes, and you just like shut it down. You don't want to look at it anymore. And I think at some point that's going to end up being the big story, because you can't keep playing this game and getting away with it. So I have just went on and on here for a while.
So Bob, just a quick recap. So you mentioned that 1903 is a pretty critical level, and if we get down and test that and break through it, what are the odds that we would drop down to those other moving averages, and in high level words, about how long would that take? I know you.
I don't know how long it would take. This was some of you may have heard this when I was on a trading floor. They gave me a nickname. If you are on a trading floor, you usually get a nickname. It's like when you're hanging around that many guys.
It's like a locker room, right?
It is a locker room, and my name was Dr. Given. And I say it's a given, it's going there. And then somebody would go, how long is it going to take? I said, I have no idea. It's just going there. So then some guy would tie me in. I said, okay, it'll be there by January. Of course, it didn't go there in January. He goes, I thought you said it was going to be there in January. And the bottom line was it went in February instead of January, so that made me wrong. And so as far as when these things happen, they take a while to develop, especially looking at this monthly graph we have in the background here. This is a big chart, and I often have referred to it as super slow motion. So you're watching this thing unfold little by little, and this takes all the noise out of the market. And that's why when I'm looking at daily, weekly, and monthly graphs, daily obviously has the most noise. Bring it in, you got zigzags all over the chart. You get to this, look how nice and even flowing this chart is. And the reason for that is the noise is out, because the time increment is the right time. And this is why we chose weekly charts to run our analysis and our portfolios on, because it takes enough. If you run it on daily, there's too much noise, there's too many trades, there's too many changes that you have to adjust to because of that volatility and that noise. So weekly charts still has some reasonable noise, but it has less noise. And long-term charts, very few people can invest on these things, and maybe not even the buy and hold guys, because they're so used to holding that when you told them to sell, they couldn't sell it if they had to. So those are one of the things that happens. Of course, haven't touched on it, but just to mention, you've got. If I go up here, let me bring up this other chart, and I've got the Dow index here. Of course, that's the story of the day, and it continues to move up. The Dow's up 0.5% again today, and this is the 60-minute graph. So if I go over, let me get Mitchell out of the way and get us both out of the way for a second, so I can go through this very quickly. But if I go over and look at the daily graph, you can see the dramatics of this rally we have, and you also see that up on the top here we have some Fibonacci projections. The VPM projection tool is telling us 87.12 to 89. We're currently 85, so it's another 4 or 5% on the Dow. So Dower's in a mini bull market. This is the daily. So let's go and look at the weekly real quick, because this is the backstory of all this. You can see here on a weekly basis that this thing is moving up pretty good. We've actually exceeded any type of pattern. From a pattern recognition standpoint, we've exceeded anything that looks like a projection right now. So it's just running in pure trend. Look at the PPMs on this page, 0.56, 0.29, and 0.14. So the 40 period hasn't even got into the trend mode yet, but the shorter term, the 10-week moving average is 0.56 and 0.29 on the 21. Let's flop over here real quickly just to get through this. Is when you look at the monthly, you can see this thing has been basing really since, you can go back to 2006. We've been in a flat range, a couple little blips here, but currencies, by the way, tend to move in 5 and 8 year cycles, and so we have just completed probably this long cycle. If you go all the way back to '03, you're looking at 11 years, not down, but 11 years since this market has moved up. So the Dow and all these indexes are currencies really get into long-term runs, and it's very possible that the Dow is drastically undervalued from a relative basis, and it has a lot to do with probably the bet here that's being made. This is an assumption, but the bet here that's being made is about higher interest rates, and the higher interest rate differential is going to drive money into this place. It's going to make our exports really expensive. We're not going to be as competitive. There's going to be a lot of other issues that come out of a stronger dollar. And meanwhile, one of the charts I haven't flopped over to, and I just got triggered on, is international spread. This thing is once again trying to put another bottom in here. And until I've talked about this so many times, it's probably getting old to all of us, but it's worth keeping an eyeball on and just keeping some perspective, is that this chart, when these charts turn up and start to trend higher, this is a trend that goes all the way back. Just looking at, this is the S&P long EFA, short S&P, which is not working, and this is what I'm looking for is when the EFA can really come into favor and start to move up. We've seen some blips on this chart where they work for a while, and if you went back and looked at these elements here, you would see that the market was declining during those phases. So the bottom line is, when this starts to trend higher, we're going to see a lot of money shifting out of the stock market here, and who knows how this thing all plays out. So it gets somewhat complex because you run into conflicts when you try to play out some scenario and putting all the markets together. But there is going to be a point in time where maybe it's at some point where the bond vigilantes show up and rates go higher, and meanwhile you've got a conflict here. You think about what's happening from a world view. Mario Draghi, the ECB chief, is trying to lower rates and do a QE program. We're trying to get out of the program, so we're completely in a different cycle. So if that happens, like it looks like it is, Europe is in trouble maybe forever. They could be a long time coming out of where they are. But the point is that they're trying to keep rates lower there. We're trying to get normalization here in the U.S., which that means the Fed is no longer driving the market. It's responding to the market as it has. I've talked about that over several weeks. And those are the things that when we start to see those elements come out, these spreads are going to change. And the markets, the stock market and those type of assets are not going to be as in favor as they are. It doesn't mean we're not in 2008, we're not 2009, so get those, at least at the moment, get those thoughts out of your head. But what we are going into is a very more risk-off situation than what we've been in for a while. And when you see these long-term trends, these things will happen. So whether it's a 12%, 20%, maybe there's a 30% decline in here, getting down toward that was 22 down to the 40 period moving average. So that's a decent, respectable decline, and we need to reset this market because there's a lot of evaluations. People are going to look at the S&P and talk about it being 17 times forward-looking earnings and all that crud. When people don't want to own stocks anymore, none of that means anything. And that's just the way it's always worked, and it will continue to work that way. One thing that hasn't changed under the sun is how humans think and how they're influenced emotionally, which is
panic buying or selling, right?
Yeah, is market sentiment, and we've been in, and I suspect now that the FOMO, or the fear of missing out, is dissipating as well, because now that the market's backed off here, it's like the anxiety is not at where it was. It's funny, the higher the market goes, the more people want to buy, which is ridiculous. I'm always a seller into these rallies, always have been. And those are points where you want to sell, you don't want to buy. And it's funny because people, I'm sure your customers and general public, they see the market going up and they feel like they got to buy something. Oh my gosh, we got to get in, we got to do something. And when you're at historical highs, you really want to be a seller. You want to be a seller up here and taking, you want to have lots of cash at the highs of the market. And at the lows, you want to have lots of cash, but you want to be able to deploy that money when these trends turn, just like we had in 2009 when this thing turned around. We had just billions of dollars, and we put it to work and had a great year. And some of the resets and volatility that we saw in 2011 was pretty unprecedented and had nothing to do with market conditions. It had everything to do with this Keynesian project that's out there. So anyway, I'm really off on a tangent here. It's like quarter till.
Hey Bob, could I? I'm just going to throw this at you. Would it be possible for you to do a spread chart on SPY and IJR? Because I know we've talked about this in concept quite a bit as far as the difference between the large caps versus the small caps, and I just wondered if what that chart would look like. And I know I'm throwing this at you live.
No, that's okay. We'll just format symbol here, and
all right.
For EFA, we'll just put IJR in there.
And we'll see what this looks like.
And there you go. So this is long IJR and short the S&P. So you can see this means IJR is way underperforming. Let's go big screen here. But it's interesting that there were sections. So overall, this thing is way underperformed. Although we talk about it led in 2013. It led for this period here, but then literally since the fall, and this is the number that everybody knows where my cursor is, around October, November last year is when that stopped happening. It wasn't even much here, but now that with this massive underperformance. So once again, I've talked about this a lot of times, is that what is causing, what does it mean with the small caps going down? They're more sensitive to the interest rates going on. 2015, by the way, there's like $4.5 trillion of corporate debt that needs to be rolled over. Most of these guys borrowed money real cheap in 2009 and 10 and even 11. And the 5-year paper that they borrowed, the 2 and 5-year paper, there's a monster rollover in 2015. So everybody knows this. They're not going to get the cheap money probably. Even now, compared to where it was, rates are up quite a bit. You're no longer at 160 on the 10-year. You're at 260, 252. So you're much different pricing. Maybe 1% doesn't seem like much, but when it comes to corporates, depending on once market sentiment and people aren't just willing to give money away like they have in the last several years because money's been cheap. And the backdrop meaning that the Fed's trying to get to normalization. What does normalization mean? It means that rates seek their market where they should be based on market conditions. And that's not where we are right now. We are in an artificial environment. My guess is puts the 30-year closer to 5%, the 10-year 3.5 plus. And then you get into the shorter end spectrum. The big moves are going to be on the lower end and the short end because that's where the Fed's concentrated all their efforts. So when that happens, and now I'm a corporation, I need to borrow this money, it's going to cost me a lot. It may cost me 2-3% on the rollover. Number one, if I've got earnings, it's going to probably suck those right out. And so my earnings potential is going to go flat. And then possibly it could even cause me to draw down a little bit and maybe earnings go flat or down, and some of these companies depending on how they're positioned. So this cheap money and trying to transition this economy is going to be an interesting thing to watch, because I think it's going to be very difficult to transition. There's probably, I don't know what the percentage is, but there's a percentage of all the companies that are out there that have come public, that have done whatever they've done in the last 4 or 5 years, probably maybe you don't even deserve to exist. If it wasn't for the cheap interest, they couldn't survive. I saw early this morning on I think on Squawk Box US that there was a discussion about all of these new IPOs, startups, the capital. You're seeing a frothiness where a lot of things are starting to get overvalued, and you're seeing deals done. And matter of fact, these venture capitalists going, especially if it's social media or anything to do with any kind of social media, it's just get subscribers. We don't care if you make money. Get viral, get as many subscribers. We'll figure out how to make money. We just want numbers of bodies. And that's why you see some of these IPOs and some of these deals come out. And what was it? I forget what company it was. I think it was Instagram, but one of them, they got hundreds of millions of people using the product, but it's free. They make no money, and they've been offered billions of dollars for these things, and they go, no thanks. We want to keep the business. And meanwhile, I don't even know how I guess there's some money, but then none of these companies are making any real money. But it's about subscribers right now. It's about bodies in the box, and they're willing to pay for that. So the small cap story is just that. Mid caps had the same issue, and that's where the safe haven to the large caps has been played out, is they don't have the same demands on capital. They have different access points to capital because of who they are. They can actually get capital easier at a lower rate, even if rates go up. So that's the perception of why the S&P is doing better and why this chart looks like it does. Long answer. You have to be careful what you ask for, right?
No, that's good.
But that's what's going on here, and I think it's one of those things that you're going to see. This chart will, since small caps have been down so much. Matter of fact, maybe it's worth oh, nice. I closed that out. That was brilliant. No, wait. No, I didn't. There we go. I wanted to reduce it. I thought I deleted it, which would have made things really interesting. But if we go over real quick on this, let's go to this chart here, and let's bring up the Russell on here. And you can see that we are getting very close to that 21 period moving average. 21's up 1.61. This is monthly. So this is leading the way to what I was just talking about happening in the S&P, where the market goes through the 10 period moving average, goes down to the 21, and then rallies. Now, it's possible that once this hits the 21, that's going to be the chart to watch. We're 0.65, if you recall, we're 0.84 on the long-term S&P, and what we're seeing here is very good trend levels underneath this chart yet. What that usually means is we'll get down to this 21 and we'll bounce back, and we'll probably go back over the 10 period moving average, which if I bring that up real quick here, you'll see that it's what we can look at here. It is 1151 on this thing would be where we move up. We're at 1113, so that's a good 15%, I guess, on the upside, right? Let's see, 10%, yeah, roughly. So 8 to 12% rally would be back, but meanwhile, it hasn't made a new high. It hasn't done anything other than rally back into the pattern, and so. That's why I keep emphasizing we're not in 2008, and this is not, the banking crisis. There's none of those elements around in the economy at the moment. You can make up a whole lot of stuff, but there's nothing that's material that's out there that's happening that would suggest that we have some major debacle on our hands. Now, there's always, the black swan events, geopolitical. It's interesting what Putin's probably like the best chess player ever. Now he's talking about blocking Hollywood out of Russia, and then and they're talking about confiscating all the foreign assets that are in there. And I'm sure they will be choosing which ones that they confiscate from these oil companies and big money that's in Russia that's made bets there. So it's the war of money versus bullets on this one. With all the sanctions they had, so they're lashing out. So there are things out there that will definitely cause disruptions. I've talked about it before. The sanctions in Russia are hurting Europe more than they are Russia in a large scale. Russia has completely embraced China, and they have quite a bit of output of goods. If you haven't looked lately, they can pretty much whatever they're doing. Maybe it's a copycat, who knows? But they can supply Russia with what they need, and also even just trying to replace the dollar. There's a whole backdrop going on that there are people that are moving away, and the Russians and the Chinese trading the yuan and other things like that. So we got 5 minutes to go, but I think a good show, because these are things that are currently happening that are setting up for what's going to be unfolding here in the months ahead. So I think at least that theme seemed to really hit big when I'm looking at everything. So Russell's ahead of things. It's extreme. You should see maybe a reallocation, maybe to small cap to out of large cap into some small cap names there's some good names out there that you can probably find. If you're screening, then maybe that's a good way to go. Don't we have a small cap screen that we have on?
We do. Yep.
Yeah. So anyway, 4 minutes to go. Mitch had all kinds of plans for this show that I just
That's how it goes.
It didn't happen at all. So, one of the things, let me bring Mitch up. I think a discussion here on, we'll just go off screen, off the markets here for a minute. But one of the things I think is that we have some things coming out in the next week or so. But I think that we are working on a whole lot of concepts and ideas for you guys to be able to use. One of the most successful things that we've done in hindsight has been our premier strategies, things like Global Equity 4 and all weather. We've got literally billions of dollars into these strategies that you folks have had enough confidence to use, and we have a lot of good feedback, because for the right clients, there's a lot of premiers out there that will do this. So we're working on a bunch of investment strategies that go from tactical MPT strategies to just classic VPM stuff. And what we've figured out is we've asked you guys for years to build it and told you how easy it was, and it's really not easy. And it's kind of one of the things we're taking on is to be able to actually go in and do a lot of these things for you, and then show you how to implement them and how to do different sleeves and those type of things. You got any comments here, Mitch?
Just that we're going to be putting out some more materials. I mean, we've heard loud and clear from a lot of advisors that they need help presenting the concepts.
Right.
And so we're going to be producing some resources to help advisors really understand what each of the different strategies are designed to do first and foremost, and then how to take those concepts and present it to their clients. And then what we're also going to be doing is rolling out some various different case studies, talking about what are some other ideas out there that you could build upon that do work, that don't work, just so that we could stem off some of these questions right at the onset when it comes time to look for new ideas. Because some of the ideas that we've seen out there have worked, and other advisors that we've heard of are just absolutely terrible ideas and just don't work. And we're going to go through some of those different concepts and talk about what elements do work, why they work, and what other elements don't work and why they don't work, or different considerations. So
yeah, and you guys know I founded this company. I built the software, so I believe in it. But it's really it's an amazing piece of software, and it's an amazing environment that I built. I know that's kind of patting myself on the back, but when it's used right, it really does magical things. We have been fired for people that didn't use it right, and it's our fault, and we've consulted them and do things. So we always reach out to you folks. If you're struggling with what you're doing, please be in touch with us, because the chances are maybe there's just some minor element or something you're doing and implementing, or the type of stocks you're screening, whatever it is, include us in there. We used to have a slogan, "We're your silent partner." Well, we want to be a partner. We want to be involved in what you're doing, because that helps us to get you to use the software appropriately, authenticate strategies so that they're being done right. And I know a lot of you guys are real smart and you have your own ideas, but when it comes into our environment, we can help you with those ideas, how to implement those ideas to make them effective with the software versus how you think it should work and how it doesn't work. And there's a conflict. We've seen plenty of cases over the years. We've had thousands of advisors come through our door, and a lot of you that are here, and we see amazingly good process out there, and then we constantly run into the stuff that just wasn't done right. And I take that on as my responsibility, just to reach out to you folks, because it's really about us showing you how to do it. So we're going to build about everything we can dream of. And if you think of some strategies that you'd like to see pre-built for you to use, let us know what those are, and we'll evaluate them. We'll certainly talk to you about them and find out what it is, and maybe it's something just for your shop, and maybe it's something for us to bring to the street, so to speak. So anyway, listen, have a great weekend, and I guess we're back on Monday again, and it'd be interesting to see how the orders are running. We're about a minute over. We usually don't run over very much, but I've been just going on and on, folks. So appreciate those of you that hung in there. Thank you. We'll keep up all the work we do, and try to keep the perspective right and see how this thing plays out. But closing, I know I'm over 1978.50 or lower today. Bad news for the market bulls. Doesn't mean we couldn't rally a little bit next week. You look to the commentary and Monday morning's meeting to help figure that out. But it'll be interesting to see what type of orders we get coming out of the system with this kind of week that we had. And because all of these stocks, and I talked about this, are right at trigger points for them to roll over. There's a lot of stuff out there. We're 39% long, and typically in the really bad markets we'll get down somewhere between 28 and 22. We normally don't go much below that. So we still have some ways to go for stocks to go. So we're looking at another 1,800, 2,000 plus stocks that could financial items that could be sold out. So we'll see how it goes. And anyway, have a great weekend. We'll talk to you on Monday.